Hey everyone, welcome to episode 26 in my monthly series where I present to you my top 3 dividend stock picks of the month that are designed for passive income, and where I'll give you a quick high level update on the overall stock market in the last month in my own words and my own opinion. So if you're new to the channel, welcome aboard. This channel focuses on a long-term buy and hold income focused or income oriented investing strategy. So the primary objective of the strategy is to generate relatively safe and consistent passive income forever, and we achieve that goal by investing in funds that primarily hold blue chip stocks and use income enhancing strategies like leverage and covered calls in order to really achieve that high income. So this strategy enabled my wife and I to become financially independent and retire in our mid-30s back in December 2019. So this channel is simply to show you guys how we invest for maximum passive income so you too can achieve financial independence as quickly as possible. And since I'm a firm believer in investing regularly over time, this series is basically me advising you on which 3 funds have great value right now. So I'm Canadian, so most of the stocks and funds I talk about on this channel are listed on the Canadian stock market, on the Toronto Stock Exchange. But since we invest exclusively on the American stock market, the US stock market, for our retirement accounts, for our RRSP accounts, 1 out of the 3 stock picks will be an American stock pick. So stay with me if you're American or you invest on the American stock market. The first pick will be for you. And if you're Canadian and you like the first pick, make sure you put it in an RRSP account because there's no 15% withholding tax in an RRSP account. So also, don't forget, guys, to check out my previous monthly stock pick videos as well if you're newer to the channel or you missed them, because a lot of those picks are still valid right now. I actually have a specific YouTube playlist where I group all my stock picks of the month videos, so it's very easy to find them. And while you're there, while you're checking out that playlist, check out my other playlists because I grouped a lot of similar videos together. So I created a bunch of playlists so it's easier to navigate the channel and the content you want to see. For example, I grouped all my portfolio unveil videos together. I grouped all my videos where I talk about my investing philosophy and strategy together. So make sure to check out my playlist. It's a good place to start if you're newer to the channel. So now it's time for the stock market update in my view. So volatility is making a comeback in April. The tech sector was probably the biggest loser. It has been that way for the last couple of months. Why? I don't really know. Maybe because the tech sector skyrocketed and went up so much in 2020 and 2021. It's maybe due to go back down a little bit. In the investing world, they sometimes call this a correction. I love that word. What exactly is it correcting? I don't really know. The fact that prices went too high, I guess, right? So the market went down near the end of April for a few days in a row, but then on the 28th of April, there was a big recovery. Why? Did something substantial happen in that one day that caused the value of multi-million, billion, trillion-dollar companies to go back up all of a sudden? No, not really, right? Nothing really big happened. Maybe there was that Netflix earnings were disappointing, but this is why I don't own any single stocks or single companies. I don't want them. The recent volatility and declines might have been unsettling for some of you newer investors out there, but in all honesty, I haven't really been paying attention or looking at it. I mean, this might be a shock for a lot of you watching and newer subscribers, but this investing channel is not your typical investing channel, that I could tell you. For those of you following me for a while now, you already know that I don't try to understand stock prices, stock price swings, as I believe it's a complete waste of time. I don't watch the news on the stock market. I don't read the articles. I don't care about what the so-called experts have to say or the predictions, or I especially don't pay attention to the more fearful rhetoric out there, like an upcoming recession, a new world order, World War III, and other crazy predictions. That's just designed to make you scared and designed to help their ratings, right? It won't help you at all. So the reality is, everyone, that the stock market is simply a representation of people's view and opinion of the world economy. So that's pretty much it. It's mostly based on feeling and emotion and not logic. So the more time goes on and the more experience you will get as a do-it-yourself investor, the more you realize that nobody really knows anything or really knows what they're talking about. Sure, there could be a few lucky people who will get some predictions right, but hey, some people have correctly predicted the end of Game of Thrones as per George R.R. Martin, and the last 2 books are not even out yet. So when you have a million predictions out there, guys, some are bound to be right. So what do? Waste your time analyzing all the predictions? No, you live your life to the fullest and let your money do the work for you, because life is short as we know it, and money never gets tired, right? It never takes a sick day or a vacation day. like Gordon Gekko says in the movie Wall Street, money never sleeps. So the point I'm trying to make here, guys, is that being nonchalant or not caring about what the stock market does is a huge privilege as a passive income focused investor, but it also comes with experience. So don't you worry, you'll get there in time if you invest like I do. So what are the 4 criteria for my stock picks of the month? Number 1, I own it myself or plan on owning it in the near future. Number 2, the fund must provide a consistent source of passive income, so a dividend or a distribution. Number 3, the dividend or distribution must be relatively safe and sustainable. In other words, the fund must be designed to provide passive income or consistent income, even if the stock price fluctuates. So this is where covered calls comes in. That really helps it to make a reality. And number 4, the fund needs to have good value right now. So what do I mean by that? Well, either the fund is trading at a discount to its NAV, or the premium is not as big as it normally is, or the sector and region that the fund is focused on is experiencing some hardship right now, which presents a good opportunity for investors who buy and hold long term. So without further ado, it's time for my stock picks of May 2022. All right, everyone. So pick number 1 is, of course, CLM. It should be no surprise for this month, right? Cornerstone Strategic Value Fund. So this is a US listed stock pick. Stock symbol is CLM. It's managed by Cornerstone. The dividend payout is monthly. The annual dividend right now for 2022 is $2 and almost 17 cents. So I put 2022 because, as we know, CLM resets their dividend or distribution annually. So CLM is a closed-end fund on the US market that invests primarily in blue chip US companies. It actually holds very, very good quality stuff. It has a very aggressive distribution policy of 21% of NAV, which is reset annually. We'll take a look at this in detail in the next couple of slides. So the 1-year high, 1475, which would give you 13% yield. That's based on 2021's annual distribution rate. But right now on April 28th, the stock price is $10.61, and I'm filming this on the Friday. So on April 29th, it's actually a bit even lower right now. So you're looking at a yield, everyone, of over 20%, almost 21%, which is absolutely crazy. So let's go to the next slide here. So here's a really cool tad bit of information that I found, and I found this in the CLM's recent annual form. So I get a lot of criticism for me liking CLM, that it just keeps going down in value. But guess what? CLM actually beat the S&P 500 in the last 10 years. There are the numbers. So in the last 10 years, of course, this is based on market price, not NAV price, however, so take this with a grain of salt. But CLM has an average return annually in the last 10 years of 17.38%, whereas the S&P 500 has 16.55%. So this just says it all. This just goes to show you that even though CLM tends to go down over time, it still has a really, really high return, because you need to remember and always count the income. Never forget that. So key points and reasoning. Well, obviously there's a recent rights offering, right? I've been getting a lot of questions, a lot of emails about this. What is it? The stock price dropped. A lot of you are panicking. Well, they actually did the same thing, the exact same thing in the exact same month last year in April 2021. This also caused a drop in stock price. So right now it's much closer to the net asset value, but it's still trading at a premium. So the latest information, you could see here, I put it, the latest information, this is about a week old though. The net asset value, so the actual value per share of the fund, is $8.52, and it has the price at $11.03, but as we know today it's about $10.50 or even less. So there is still a big premium to the NAV, which means that the stock price is higher than the NAV price, but CLM usually trades at a really, really big premium, 30, 40, 50% or more. So the premium is a lot lower, which is a great entry point. So that's point number 1. And by the way, fun fact, it was also a stock pick for May 2021 last year as well, because of the drop of the rights offering. So obviously this fund, we're income investors. It's very attractive because it has a very, very high yield. Its distribution policy, this is why the yield is so high, because its distribution policy or dividend policy is the most aggressive I've ever seen, that I've ever come across. 21% of NAV. I've seen 8.5%, 10%, 12.5%. That's RIV and OPP has that. But 21%, that's just really, really beyond. So it means that basically they give out in income 21% of the fund's value, of the fund's NAV. And this is reset annually. So whatever the NAV is, apply 21% of that, and that's the annual dividend. So one good thing about this fund is that not many people know, because they don't even do the research. It holds quality blue chip stocks. So I show this in my CLM video, which I strongly suggest you check out, where I go more in detail in CLM and view the holdings. So this fund really only pretty much holds blue chip quality stocks. It also holds some closed-end funds and ETFs, maybe like 10 or 15%, but the bulk of it is really quality blue chip stocks. So this fund, the share price does tend to go down over time, but with this distribution policy, I think it's normal. Okay, that's my opinion, and that's what I show and explain in the CLM video, which I suggest you check out if you're interested. Like we saw in the previous slide, I couldn't believe this when I saw it. It was a pleasant surprise to me. CLM actually is beating the S&P 500 over the last 10 years in terms of annual compound returns. However, that figure or that stat is based on the stock price, or the market price, not on the NAV price. But word of caution for CLM, guys, if you're interested, I would only go a small position here. Do not make this a major part of your portfolio. I would say max 10%. 5% is reasonable to me. This is a higher risk. And when I say risk, it's not because of the quality of the stocks. The quality is good. It's more of a higher risk because the distribution could fluctuate every year, and it's based on the NAV price, and it tends to go down. The stock price tends to go down. But will the fund manager keep the distribution policy at 21% of NAV? I don't know. Maybe they'll change it. They'll make it less aggressive, so the fund might go up eventually. I'm not sure, but keep in mind that the fund manager could change the policy anytime they want. So keep that in mind. Stock pick number 2, my Canadian listed stock picks now, is HYLD. I love this fund. This is probably my new favorite ETF right now on the Canadian stock market. It's the Hamilton Enhanced US Covered Call ETF. The dividend payout is monthly. Right now it's $1.68 a share. It actually went up 3 cents. Only 3 dividends came out for this fund, or 3 distributions rather. The first 2 were at $1.65 annually, and they actually increased a little bit to $1.68. A very, very nice and pleasant surprise. So what is H-Yield or HYLD? Well, it's an all-in-one covered call solution that holds, so this ETF holds inside of it 7 covered call ETFs. So we'll check those out in a second. So the exposure of this fund, like the name says, right, US, is primarily on the US stock market. And on top of those 7 ETFs that it holds on an equal weighted basis, it adds 25% leverage to the overall fund. That's what enhances the yield and return, which, as you could see right now, based on the April 28th stock price of $15.64, it even went down a little bit today. It's a little bit lower. Actually, with today's decrease, stock price, it passed 11% yield. So I have it here at 10.78. That's based on the April 28th price, but right now it's a bit lower, so the yield is a bit higher. Absolutely incredible to get 11% yield, guys. This is not even a split fund. I'll show you, we'll check it out in detail in a second. So the 1-year high, although it doesn't really it's not really great information because the fund's only been out for a few months, 17.27. So that would translate to a yield of 9.72, but right now you're getting over 11%. So why is this the stock pick of the month? Well, it's because the US market, and especially the tech sector, has gone down recently, and H-Yield is a great way to capitalize on it because it focuses on the US market, therefore focuses a little bit more on the tech sector. I also love it because you literally have automatic diversification with one ETF. It's not only tech. You have high yield of over 10%, right now 11%. And this fund, this is a regular ETF, so you get that really high yield without the structure and the risk of a split share fund or a split corporation where there's a risk of missing dividends. When I say risk, by the way, I'm not talking about the quality of the stocks, because all the funds I invest in have high quality. It's more of a risk of volatility, stock price increase, decrease, which doesn't make much difference to us buy and hold investors, but split funds have that little risk of missing dividends when there's big crashes. So dividend increase 165 to 168, a very pleasant and welcome surprise. And this ETF holds, in my opinion, the top 3 best covered call ETFs on the US stock market: QYLD, RYLD, XYLD, all managed by a Global X, which is a sister company to Horizon's ETFs here in Canada. So these are dream come true ETFs, in my opinion, for income investors. They're not even leveraged. They focus on the big indexes on the US. So basically, if you have QYLD, which is the NASDAQ, RYLD, which is the Russell 2000, so you get taken care of for your small cap to medium cap exposure, literally has 2,000 companies in there. XYLD is the S&P 500. So those are the three big indexes in the US, and you have those three, you actually have the whole US stock market. So those three are three of the 7 ETFs in there. But I also love the fact, like it says in my next point, that HEP and HHL are in there as well. HEP is gold producers, HHL is all healthcare companies. So very, very defensive exposure. So you do get some defensive exposure with those two, and also some companies in the HBF ETF, which is the Harvest Brands ETF. There's some defense in there. There's things like Procter & Gamble, Pepsi, McDonald's, some very defensive names as well. So it not only do you get exposure, yes, there's a lot of tech exposure, UX exposure, but there's also a lot of defense in there. And this is why HYLD, the price, went from 17 to 15 to 16. It doesn't fluctuate that much. That's thanks to the defense. So I really, really love that. Make sure you check out my H-Yield video where I actually talked to the CEO, Rob Wessel from Hamilton ETF. So make sure to check it out. We talk about this ETF in detail. So if you haven't checked that out, that's a thumbnail. And of course, I'll put the link in the video description below. Stock pick number 3 is, I decided to put in more of a safety ETF because of the volatility. So this might help you in case you're a newer investor and you want a little bit of safety or you want a little bit of cushion. So it's Financial 15 split fund, but the preferred shares. So the stock symbol is FTN.PR.A. That PR stands for preferred. So the manager is Quadrivest. They manage a lot of split funds, and the biggest split fund in Canada, which is DFN, Dividend 15. The dividend payout is monthly. The annual dividend is just under 68 cents a share. So the 1-year high stock price, 1084, giving you 6.23% yield. Right now, it's about 1014, which is 6.66% yield. So Financial 15, the split fund, holds 15, like the name says, North American financial stocks. So we'll check those out in a second. And the preferred shares have priority on the assets and the dividend coverage. So they're very, very safe. And the stock price is extremely stable. It tends to be always in the $10 range. And the management fee is 0.65%. So here is the top holdings, or the actual 15 holdings of Financial 15. So pretty much it's about 60% Canadian, 40% US. So in the US, we have basically the top 5 banks: Bank of America, Goldman Sachs, Wells Fargo, JP Morgan Chase, and Citigroup. So that actually makes up 40%. So just because there's 15, you would think that those 5 make up a third. They actually make up a little bit more. They make up a nice chunk, 40% or 45%, something like that. And the rest are really the top 10 in Canada. You got the top 6 banks, of course, which we all know by heart. The life insurance companies as well: Sun Life, Manulife, Great-West Life, and you also have a small percentage in AGF Management, which is an asset management company. But what I want to show you here with these 2 diagrams is, a lot of people ask me, FFN, which is another split fund. It's called the North American Financial 15 split fund from Quadrivest, by the same guys. They literally have the same 15 companies. And there's always a debate, should I get FFN or FTN for the preferred shares? Well, I think definitely the Financial 15 ones are better because of the asset coverage. So if you actually go on their website and click on update, it's a bit hard to find, but I think it's news and updates, and click on the latest update, this is where you will find this information. So if you notice here, FFN, the asset coverage of the preferred shares, because keep in mind the preferred shares are very, very safe. In case there's a market crash, the preferred shares are very protective. The asset coverage of FFN is 155%, whereas the average of FTN is over 200%. So as you could see here, there's a lot more FFN preferred shares out there and a lot less Class A shares, but in FTN it's the opposite. There's more Class A shares than preferred shares. So it just means that the preferred shares are that much more protected in case of a crash. And 204 to 155 is actually a big difference. And by the way, the FTN has higher asset protection than Dividend 15. Dividend 15, I think, is at 180%. And Dividend 15 preferred shares have a yield of about 5.5%, whereas FTN is about 6.6%. So for me, the winner is clear. My top, if you would ask me, my top safety fund right now, it would probably be the preferred shares of Financial 15. So key points and reasoning. So although usually it's not always necessary for most people, having 1 or 2 safety funds can help investors cope with the stress of stock market volatility. I always tell people it could be you could have 1 fund or 2 in case you need an emergency fund. usually it's if you have a net worth of over 500,000, you probably don't need it. But hey, if it makes you feel better, guys, go for it. Do whatever makes you sleep better at night. So the preferred shares of any split fund really provide safety and stability because their stock price hovers always around $10. Why? This is because they don't capture the stock price movements of the fund at the top. Don't forget that there's split funds. There's a fund at the top, and then there's the preferred shares and the Class A shares. And the Class A shares capture all the movement of the stock price. The preferred shares don't. That's why they barely move. They're always at about $10, $10.10, $10.50, and they're always about that price. Very, very boring, and that's the point. So like I mentioned, of all the split funds, the preferred shares of FTN is my top choice for the following reason. Number one, the Quadravest ones, they have monthly payouts instead of quarterly payouts. All the Brompton ones, so GDV, LBS, SBC, all their preferred shares are all quarterly payouts. The Quadravest ones are monthly payouts, which is nice. Over 6.6% yield, which is higher than DFN, right? The Dividend 15 one, and one of the highest one of the highest yields for preferred shares of split funds in general. Asset coverage, like we saw, is the highest. It beats DFN and FFN at over 200%, which means it's a lot safer if there's a crash. There's higher downside protection. And this little diagram I took directly off their website, which explains the preferred share. So as you could see, quality investment, diversification, diversification within the financial sector because it's all financials, but you have US and Canada, which is cool. Strong downside protection, even has a downside protection rating because the preferred shares are kind of like, fixed income, so to speak. So this is probably my top choice for safety. So if ever you're a bit scared of the volatility that might be coming and might be getting worse in 2022, I'm not predicting, I'm just saying it's possible. If you want to put 10 grand, 20 grand aside, 50 grand to make you feel better, FTN is a really, really good choice. At least you'll make 6.6% yield on it and you'll have a very high degree of safety. Is it perfect? Will it not move at all? No, it still can move, but it tends to stay very, very firm at $10. So it's a great pickup for safety. Thank you so much for watching, guys. I really appreciate it. Please show your appreciation by hitting that like button. It helps the channel grow. It's free for you. It's a win-win. It takes 2 seconds. I would really appreciate it. Also consider subscribing if you like this type of content. My channel is all about investing for maximum passive income. So please subscribe, hit that little bell button as well so you're notified whenever a new video comes out. You don't want to miss my upcoming content. And of course, make sure to visit our website, passiveincomeinvesting.ca. That's where you could purchase and sign up for my digital product, the ultimate DIY investing package, which is on version 3 right now. So I'm very proud of this product. I'm very proud of this package. It comes with lifetime updates, so you only have to buy it once. And when you do, you will have all the next updates for free. And I do plan on making version 4, coming out with version 4 in Q3 of 2022. So that package will help you invest on your own. Basically, it has lists of funds, ETFs, closed-end funds, split funds, as well as a lot of sample portfolios. I have sample portfolios for Canadians and Americans and tailored to different investing needs, not just income like I do, but also growth, also dividend. There's low risk income, aggressive income. So it's a very, very cool product to really help you build your own portfolio. That's really what it's designed for. So make sure to pick it up if you haven't already purchased it. And of course, there's also a bunch of free tools and resources on my website at the top right, free tools and resources. And right there on the homepage, I do offer a one-on-one consultation service with yours truly. So if ever you want really more personalized help, you could book a one-on-one with me. We'll have a 1-hour Zoom call. I'll go over your existing portfolio. I'll help you transition to an income portfolio. I'll answer all your questions, whatever your needs are. I really love helping people out, and my appointments do sell out very, very quickly. I apologize. I can't do more than 4 a week because I need time to do the content, to publish more content, of course. So just look at the little message on top of the calendar right there on the homepage to get a status of the appointments. Usually I will open up the appointments for the next month on the 25th of each month. So stay tuned for that. And also, if you want to join our community, we have a Facebook group with over 10,000 members now. Passive Income Investing, that's the name of the Facebook group. So if you like this sort of content, I strongly suggest you join the Facebook group. We monitor it very closely for spam, so it's very, very clean, and everyone shares their ideas and shows their portfolio and the income they're making every month. It's very, very exciting that the community is growing. So make sure to join us on Facebook. We're also on Instagram. So Instagram, make sure to follow us if you want a little bit more personal content on our life, including our move to Panama. So if you want a little bit more personalized content to us, you could always follow us on Instagram. So the mission of this channel, my mission, will never change. It will always be the same, everyone. It's to help everyday, normal, regular people invest on their own, to do it yourself investing, so they could build their own stream of passive income and enhance their quality of life and eventually become financially free, financially independent like us. So with that, take care, guys. Make sure to stay healthy, stay safe, and of course, stay passive. See you next time.